The debt ceiling crisis has officially been kicked down the road for another 2 years. And we've even got the stock market up 12% year to date, with some stocks like Nvidia even doubling in price in that same exact time frame. Couple that with a jobs report that just came out last Friday, blowing expectations out of the water, it looks like we may actually avoid a recession and have a soft landing. But while everything looks nice on the surface, if you look a little bit deeper, there's a very big problem brewing that could change all of this. That's why today we're covering why unemployment might be worse than we actually think, why the stock market is in danger of a big decline, and coming rate hikes could speed up all of this pain. Now, before we move any further, if you guys want to support the channel in any way, then you can go to our newsletter, which is the first link in the description down below. Go check it out, go subscribe, and then that way you can stay up to date on events like this even sooner. Now, the first place we need to start is the jobs report that came out on Friday. The main reason is because this plays into the whole picture of what the Fed will do next. Now, the Fed has two main goals: low inflation and low employment. At the moment, they're reaching one of those goals if you look at the numbers that they're posting, and that's low unemployment. Again, their goal is a 2% inflation rate, which they're not there yet. But with a strong labor market posting, this allows them to continue to raise interest rates until they can actually reach that 2% goal. Now let's actually go over some of the details in the job post. Now when you look online and you look up the jobs report, you're going to see something that has somewhat of a good connotation to it. Right here on CNBC, it says payrolls rose 339,000 jobs in May, much better than expected in resilient labor market. And basically, jobs rose 339,000, as expected were 190,000, so almost doubled that. Unemployment did rise from 3.5% to 3.7%. And again, when you look down here, you can see that basically over the last 14 months, we've had job rises over and over and over again, which seem to show a healthy economy or a healthy employment. And again, if you look at the statistics of year over year percent change in average hourly earnings, again, that has been going up as well. So when you take a look at this job report, or if you just look online at all, you're going to see that, yes, this was a very good report. But as we start to peel back the onion, we start to see some contradicting evidence that maybe this wasn't actually a good report. Now, some pieces of evidence is the first thing is that, yes, we did raise 339,000 jobs, which is good for the economy, so to say, but inflation did rise, again, 0.2% from 3.5 to 3.7, which doesn't seem like a lot, but we are starting to increase. Now, one very interesting thing about this jobs report, or really the last 14, is that we are at historical highs of streaks where we have beaten the expected non-farm payroll reports. Now, this comes at a very interesting time, as it's basically lining up exactly when we started to raise rates in order to fight inflation. Again, remember, the two main goals of the Fed is low employment, unemployment, and low inflation. If there is a massive rise in unemployment, then the Fed has trouble raising rates, because raising rates causes the economy to slow down more. And if there is high unemployment, then that's not going to allow them to do the job that they really want. But again, with a 14-month streak in terms of beating the non-farm payroll reports, are they either lowering their expectations, or are they fudging up the numbers in order to beat this, which comes at a very, again, interesting time, as the last time that we had a streak was 6 times in a row, whereas now it's at 14. And again, if we continue to peel back the onion, the number that was beaten on this jobs report was 78% above expectations. The last 14 consecutive months, we have beaten expectations. And again, the average number that we've beaten these expectations has been around 48%. And in January alone, the jobs report was 172% above expectations. And this claim is that, are the expectations being manipulated? Are they too low? Because obviously something doesn't add up here. How are we having such an amazing job market when you do look online and all you see is big companies like Meta and banking and all of these massive companies laying people off? And another statistic that is somewhat being manipulated is the hourly earnings. Yes, you could look at it and say the hourly earnings are actually rising, but that's when it's not adjusted for inflation. When you do adjust it for inflation, we are actually down because of how high inflation is. But again, in the public media, when they're trying to pump you good news, they're not going to include that important detail. And another piece of evidence that they forget to add purposefully is that when you look at the household survey, we're actually down around 300,000 jobs, 23,000 from full-time and 220,000 from part-time jobs. Again, this is a mixed report where you see a lot of bad evidence, but the only good thing is that we've added those non-farm payroll jobs of 300 plus thousand. But again, when you look at all the other evidence, things are actually not looking that good. And again, as mentioned earlier, the main concern for the Fed right now is keeping unemployment very low. And again, we've been at historical lows, sitting here at around 3.4% for a few months. And now we've just risen from 3.5 to 3.7%. Now, typically the Fed will not be concerned until we start to reach levels of around 4.5 to 5% unemployment. But until that happens, they're going to continue to raise rates, which we'll talk about later. And in terms of that, a recession, when you take a look back, usually happens before we see a massive rise in unemployment. But typically, the unemployment rate after a recession hits levels around 8 to 10%. And right now, we're again sitting at historical lows right around that 3.7. So until we actually start to see a massive rise in unemployment or a very large increase, that's when the Fed will be concerned. But for the next month, they really have nothing to concern about, according to the numbers. Now, again, couple that with an absolutely booming stock market. I mean, since the year to date, if we go back to January, we can see that it's been up around 12 to 13%, which is extremely good for the S&P 500, considering all this talk about a recession or economic slowdown, and we've had over 10 interest rate hikes back to back to back. So then when you look at the stock market, you're like, yes, we've had this massive decline since right around here of January of 2022, all the way from this peak to the bottom. We've seen a decline of around 27%. But since then, we've actually risen in the stock market. So what a lot of people will also say is that if you look at this downtrend, a lot of people will say that, hey, we've broken a critical downtrend. And at this point, we might start breaking out to the upside and the recession may have been over. We have a soft landing and we might actually see another bull market coming in. And another interesting piece of evidence is that when you look at when we started raising rates back in March of 2022, we're actually at very similar levels right around here. So it seems like all the effects of interest rate hikes have already been taken into account with this drop right around here in this entire section. But since then, the stock market has recovered and we've been doing fine. But again, as we continue to peel back the onion, we start to see contradicting evidence. And again, some of the contradicting evidence that we're looking at is that if you just take 5 S&P 500 stocks and put them into an index alone, those 5 are up 86% this year. Those being Meta, Nvidia, Microsoft, Apple, and Tesla. Meanwhile, the entire S&P 500, again, like we talked about, is up 12% this year. If you were to take those 5 extremely performing stocks out, the S&P 500 has actually been flatlined. And again, the S&P 500 or the entire stock market has been booming because of the AI boost. So right now, the entire stock market is being driven by tech companies due to this AI boom, which is very concerning because now we're starting to reach some critical levels where we've had support and resistance that have been historically important. Again, also climbing up to this very important number of 4,300 for the S&P 500. Once the AI craze slows down and these big tech companies that are carrying the entire S&P 500 start to report a little more of poor earnings or whatever it may be, and they start to get sold off, if they're carrying the entire S&P 500, it wouldn't be a shock that they also bring down the rest of the S&P 500 with them. And that's where we can get this massive decline. When these 5 companies that are carrying it start to struggle, then the rest of the market will also start to struggle. And that brings me to my last point, where the Fed is going to have a meeting on June 13th or 14th, and they're going to be talking about another rate hike in June. While a lot of people are saying, a lot of economists and a lot of the Federal Reserve boards are saying that we should skip June because we have good data to support it, while everything is doing well except for inflation itself, they're saying that I think we should pause because the pause says that we're going to hold for a while, and we might. Meaning that even if they don't raise interest rates in June, that doesn't mean that we've stopped. That doesn't mean we've hit the summit or the peak. It means that they're just going to stop for a month and then they can continue into July, August, and September, depending on how bad inflation actually starts to rise. And that was kind of an important metric that if we take a look at core personal consumption or the PCE year over year, one thing is that it was kind of declining slowly. And then here, over the last month, it actually jumped from 4.6% to 4.7%, which doesn't seem like a lot. But when your main goal is to bring down inflation and it actually changes directions and starts to rise again, it's somewhat of a concern. And again, this is going to push the Fed into a decision where unemployment is doing very well according to the numbers that they're putting out. The stock market is holding up, but yet inflation is still high. That's going to push for more interest rate hikes. And down the road, that's going to put more pain into the markets because as these 5 companies that are holding up the stock market start to decline, so will the entire market. And as these job reports, who knows how they're being manipulated or how they're being presented, but 14 months in a row where we're beating expectations at record numbers just seems a little fishy to me. So that's everything I have. That's definitely something to keep in mind as we could see a massive decline in the markets here coming very soon. But again, I will keep you guys updated on everything that I know and everything that starts to come out in a timely fashion. But until the next video, I'll see you guys then.